Remember last month when everyone was panicking that the market was about to snap? Well, let's take a bit of a look at how the market snaps look like this month. Oh, that's a bit awkward. So, in this video, I'm going to show you how my portfolio's performed over the last 30 days following the foreseen market snap. Apparently, all the signals were showing that the market was doomed. So how has this impacted my account over the last 30 days? I'm also going to be sharing my thoughts and give you some insight on my answer around the question that every investor asks. When is the single best time to buy into the stock market? If you think you know the answer, then feel free to stop the video right now, write it in the comments section so we can see if our answers match up. No cheating though, no commenting after the video has been done, okay? Promise? And while you're on the way back up from the comments section, feel free to turn the thumbs up icon to a lovely blue colour. It looks a bit weird when it's grey, doesn't it? It's a bit like having the volume on the TV set to an odd number. Oh, gives me shivers thinking about it. So let me quickly address the vibe across the investment community at the moment. All the commentary at the moment is all around inflation, stock market bubbles, high levels of debt, the economy reopening, the third wave of the illness we're seeing in Europe. There's a lot of uncertainty to say the least. Investing is never easy, especially if you're starting out. But the stock market currently probably has the most even seasoned investor quite nervous at the moment. If you're new to investing, then this is normal. There is always going to be someone screeching that they believe the stock market is going to collapse any second, and then there's always going to be somebody telling you the latest IPO or tech startup or latest crypto coin is about to 100x. They're always going to be there, so you need to get used to it. And what's even frustrating, some of them will be right sometimes. I've even done a video talking all about it, so feel free to watch it. There should be a banner somewhere in the top right. If you'd actually listened to the majority of sheeple last month, then you would have actually probably sold your position. But let's have a look how you've been rewarded if you sold this time last month. As of typing this script, the S&P 500 is up more than 4% in the last 30 days. So if you'd sold out at this point and now wanted to buy back in, you would have lost 4%. I thought the end was nigh. On top of this, during this period, a lot of funds will have had their ex-dividend date, meaning if you'd sold out, you would have missed being eligible for the dividends for latest quarter. Double ouch. Consider the average market return is about 8% a year. This selling out of the market and buying back in would have pushed your investments back 6 months. Before I discuss when is the best time to buy stocks, let's see how my Vanguard account's performed over the last 30 days. For any new viewers, then my fund of choice is a FTSE All-World UCTIS ETF. Luckily, this ETF has a ticker symbol, so I don't have to say that all the time, which goes by VWRL. I've done a video on why this is my fund of choice, so feel free to check this out. I'll put another banner somewhere over my top right shoulder. My platform of choice is Vanguard. I have had a lot of questions on why I don't use another platform to buy Vanguard funds, like Trading 212. In a nutshell, I choose Vanguard and I'm sticking with them, and it's for these 3 key reasons. 1. A lot of Vanguard's fees are written on the door and there aren't any hidden ones. I hate it when there's hidden fees and I can't be bothered with it. 2. Their fees are low. And 3. I trust them, which I really can't put a price on. Their size, scale and their brand helps me feel secure that my money's being really well looked after. I'm not affiliated with them in any way, so I'm not getting paid for saying any of that. I'm not going to lie though, I wish I was affiliated with them. Let's get to the good bit then. How big has my cash snowball gotten? Just a reminder, at last month's check-in, my account was a little over £51,000, with my VWRL shares being just under £78 a share following a recent sell-off. So it was the first time we'd seen a sell-off in about the last 4 months. I think the one previous to this was October. So, you know the US stock market bounced back, but what has VW's done in that time? Well, quickly after my last update, the market sharply recovered over the following 10 days and actually got to £80.60. Since then, it has traded sideways quite a bit, leaving us just over £80 at £80.08. Not bad, considering that my share price this time last year was £57 a share. Imagine selling out back then. Ouch. It's sad to say, but many people did sell out at this point. There was actually an example of a high-profile investor on YouTube doing this. His rationale for selling at the time was a very, very solid one. He just couldn't see how the economy could survive a sustained lockdown. But for him, sadly, he got this very wrong on this occasion. So, where is my Vanguard account valued at? Well, for the first time, we've actually pushed past the £53,000 mark with a sum of £53,192. On top of this, any day now, I'm due to get my last quarterly amount of dividends, which should be about £160, taking me to about £53,350. VWRL's dividend is around 1.7% a year, but this does move. So that means on any given quarter, I should be getting about 0.4% on average. But the quarters aren't balanced, so some quarters are bigger, some are smaller. To clarify, I have engaged £2,000 the last month though. £700 of this is my typical direct debit, which is part of my dollar cost averaging strategy. If you want to learn more about dollar cost averaging, then feel free to check out a video that I made a few weeks ago. Again, banner somewhere up in the top right. My investment gains are still just short of £10,000. I think it's around about 9,560 at the moment. But then, with my dividend on top of this, I'll only be £280 short of this 5-figure mark. I really want to break it. So here's to me hoping that the share price jumps shortly by about 43p, as it should be enough to get me to that 5-figure club mark. If you're interested in news updates around Vanguard, then I actually posted a video 2 days ago about one of Vanguard's brand new funds that only launched literally a few weeks ago, which revolves around ESG. So if you want to know more, banner in the top right. So, at the start of this video, I said I was going to share with you my thoughts and some insight on when the single best time to invest in the stock market is. I hope you've already commented down below, no cheating. So what is my simple answer to this question of when the best time to invest in the market is? Well, my answer is now. The answer now is not going to be just true today, it's going to be true tomorrow, and it's going to be true from a year from now. I did share a detailed amount of research in my dollar cost averaging video, but what I'll do is I'll share a condensed version now for you so you can see. So to illustrate my point on why investing now is the best time to invest, I'm going to draw on some research that I found, which is on the website of Dollar and Data. They do some great content on there, so feel free to check them out. The article that I'm referring to compared two strategies. One was dollar cost averaging that you should be aware of, and the second was something they called God mode. God mode might sound like a bit of a weird name, but I will go on to explain. This is where someone had the foresight to buy the market at the most perfect dips. So this was the lowest price point between two all-time highs. Literally buying at the lowest point possible in the market for that relevant period. The only rule for both strategies was that they couldn't sell. It was a buy and hold strategy on both sides. So you probably sat there thinking, surely God mode is the best strategy. You'd be buying the perfect dips, right? Well, let's find out. The research uncovered some really interesting insight, as it wasn't a clear-cut victory one way or another, but there was a trend. The trend was that over a broad time period, dollar cost averaging beat God mode 70% of the time. 70%. I knew the strength of dollar cost averaging, but I thought it was remarkable that it could beat something as strong as buying the most perfect dips. The research was based on the S&P 500 between the 1920s and the 1980s. To demonstrate what impact this would have on your investment and the final balance, when it compared God mode versus dollar cost averaging across this 40-year period, and in this case it looked at between 1975 to 2015, dollar cost averaging returned 20% more than God mode. That's a massive difference. This doesn't mean that dollar cost averaging is always dominant though. It was found that during periods of significant volatility that God mode did outperform. So examples of this is in the 1930s, 1970s and 2000s. So 3 periods over 100 years, so not that often. So why does dollar cost averaging outperform so often? Does it really make a lot of sense? Surely, if you buy the most perfect dips, then you're buying low and selling high, right? How could it be any different? Well, the longer your money is sat out of the market, the more it loses its purchasing power due to inflation. On top of that, you're missing out on sweet, sweet dividends. You do need to remember one key factor here though is, no one on this planet has been able to replicate the results of God mode. Most people either buy too early to buy the perfect dip or buy too late, and definitely nobody can do it consistently. So the next time you hear someone saying, I'm waiting for the most perfect dip, just know that even if they get it perfectly right, there's only a 3 in 10 chance they're going to beat your dollar cost averaging strategy. Some food for thought. Do remember though, I'm not a financial advisor, so if you're going to make investment decisions, then you're going to have to make them all by yourself. Just to give you a quick update on other investment plans that I have, I was planning on doing a stock picking series with my dog, which I'm still looking into, don't worry, but I have had to put it on hold because I still can't get a Trading 212 account. I have been looking at other platforms such as Stake and Hargreaves Lansdowne, but their fees are so high and I refuse to pay them. However, in better news, I have cracked on my crypto portfolio though, and I've actually got a crypto portfolio update coming out in the next few days. I've got to say, just to give you an insight in that episode, there's been some really fantastic performances, so I would definitely check it out when it comes out. I definitely do get some backlash though on my crypto selections though, so yeah, it'll be an interesting one, do check it out. Anyway, that's all for this video. Let's see what happens during May. Is the market going to finally snap, or is it going to continue on with its bull run? Well, the prediction that I made during January that we're probably in for a fairly long period of stable share prices. But the beauty of it all is that nobody can predict what's going to happen. All I know is I'm going to be keeping up my dollar cost averaging strategy. So if you've made it this far, then a massive thank you from me. If you have any feedback on what else you'd like to see, then do let me know. I have created 2 videos so far, following suggestions made in my comments section, and I've actually got 3 furthermore in the works, so don't be afraid to ask. I also create other content on this channel around the topics of investing, finance and income growth, so feel free to check them out. My personal favourite video, which isn't that popular by views weirdly, is 5 inconvenient truths about investing. It's only a short one, less than 8 minutes I think, so feel free to check it out. That's all for this video. See you in the next one. The trend was that over a broad time period, dollar cost averaging beat God mode.